In an increasingly interconnected world, the global economy is susceptible to a myriad of challenges that can ripple across markets, currencies, and investment portfolios. As recent trends and events point towards an imminent economic slowdown, it's imperative for investors to be both vigilant and strategic. This comprehensive guide aims to dissect the multifaceted risks currently looming over the global economy, and offers actionable insights for investors looking to safeguard their assets during uncertain times. From understanding the nuances of escalating interest rates and inflation to adapting investment strategies, this video provides an in-depth look at how to prepare for and navigate through potential economic turbulence. 1. Escalating interest rates. Central banks globally are ratcheting up interest rates to stave off rampant inflation. While this tactic may dampen inflationary pressures, it simultaneously makes borrowing more expensive for companies. High interest rates can impede business investment and expansion, thereby putting the brakes on economic growth. 2. Soaring inflation. Inflation is clocking in at levels not seen in decades across numerous nations. When inflation surges, it erodes the buying power of consumers, which can in turn depress demand for goods and services. Lower consumer spending can result in a sluggish economy. 3. Potential surge of EG5 variant. The EG5 subvariant of the Omicron virus is characterized by heightened transmissibility. A resurgence of COVID-19 infections could usher in a fresh round of economic uncertainties and disruptions. 4. Conflict in Ukraine. The ongoing war in Ukraine is spilling its economic impact beyond its borders, especially affecting Europe. Elevated energy prices and disrupted supply chains arising from the conflict are further burdens on worldwide economic growth. 5. Decline in Baltic Dry Index. The falling Baltic Dry Index, a metric measuring the cost to ship raw materials, is a worrying sign that international trade is decelerating. Immediate measures. 1. Boost cash reserves. Increasing liquidity will offer a financial buffer should your investments falter in value. 2. Limit risk exposure. Decrease investments in volatile assets like equities and bonds that are likely to suffer during economic stagnations. 3. Opt for defensive assets. Consider investing in assets that generally maintain their value even when the economy is faltering, such as gold, cash, or real estate. Long-term planning, portfolio rebalancing, transition into a more conservative allocation of assets to mitigate risk. Dollar cost averaging. Investing a constant amount of money periodically helps to neutralize the effects of market swings. Asset and sector diversification. Spreading your investments across different asset classes and industries enhances resilience against market volatility. Caution in decision-making. Abstain from drastic investment choices during market slumps to avoid potential long-term damage to your portfolio. 1. Geographical disparities. The economic slowdown's impact may vary from country to country. Therefore, it's crucial to monitor the economic climates in nations where you have investments. 2. Longevity of the slowdown. Be mentally and financially prepared for a protracted period of economic stagnation, which could last months or even years. 3. Bear market possibility. A lengthy economic downturn could trigger a sustained bear market, causing a significant dip in portfolio values. In conclusion, the world is navigating through a complex and volatile economic landscape, teeming with challenges that range from mounting inflation and interest rates to geopolitical conflicts and potential health crises. These issues do not exist in isolation, they interconnect in ways that can exponentially compound the risks investors face. While it's impossible to predict with certainty the trajectory of the global economy, proactive planning and a flexible strategy can be invaluable tools for risk mitigation. Whether it's by enhancing liquidity, diversifying asset classes, or adopting defensive investment postures, the objective is to build a resilient portfolio that can weather economic storms and ideally, emerge stronger in the aftermath. Beyond immediate tactical responses, long-term planning is crucial. As the adage goes, this too shall pass, but the length and severity of the economic downturn remain variables that require attention. By staying informed, reassessing strategies in light of emerging risks, and making thoughtful decisions based on a nuanced understanding of both the global and local economic climates, investors can not only secure their current assets but also position themselves advantageously for the eventual upswing. It is in times of uncertainty that the most prudent and informed investors often find the greatest opportunities. Therefore, consider this period not just as a time for caution, but also as a moment for thoughtful recalibration and strategic foresight.